Business owners, have you ever been in a situation where you're seeing revenue go up and you're still wondering where the cash went? You look at your income statement and you see nothing but profit, but you're still feeling that cash crunch when it comes time for payday. Have you ever asked your CPA for a cash flow statement, only to receive a financial package weeks too late for it to be of any actionable use? Hi, my name is Barrett Young and I'm one of the partners here at GW CPA. And today we're going to go to the whiteboard and I'm going to show you how you can use your balance sheet to create an indirect cash flow statement. This is a way that you can gain some insight into your company's strength and understand cash flow for yourself. The indirect method starts with net income from the P&L. And so let's say that net income on the P&L was $80,000. It starts with that number. What we're going to do is we're going to get to beginning cash and ending cash. If ending cash is greater than beginning cash, that means that it's a positive cash flow for the year, right? So let's say beginning cash was $20,000 and ending cash is $30,000. So our cash flow is a plus $10,000 for the year. This is what a cash flow statement will get down to. What happened to all that cash? So we're going to start with our net income amount. The first thing that we're going to do is we are going to look at cash flow from operations. So the first thing that we're going to do to this net income number is we're going to add back our depreciation, because depreciation is an expense, but it's not a cash flow item. So we'll go ahead and we'll add our depreciation up there. We'll also, some of the things that we're going to add or subtract are going to be our differences in accounts payable, our increases in receivables, and other liabilities that we might have that are operations. So for example, receivables. If I started the year with 30,000 receivables and I ended the year with 40,000 receivables, that's $10,000 of my revenue that's locked up in receivables. So I've received $10,000 less cash because of the increase in AR. And so an increase in receivables is going to result in a subtraction from our net income, whereas an increase in payables is going to result in a addition to our net income number, right? So if my payables, if I owe $5,000 at the end of last year and this year I owe $10,000, that means that I've kept $5,000 worth of my cash. Cash has gone up $5,000 for the year. So this is operations, right? So net cash from operations was plus $5,000. This is too small for us to get to $10,000. Let's say that our AR went up $40,000 over the course of the year. So we've got net increase from operations is going to be 10, 5, that's 15, minus 25,000. So we're now at $55,000. Okay, so that's operations. That's the first section of the indirect cash flows method. The next one is going to be investment. So this is going to be cash flows from investments. All right, cash flows from investment is going to include cash that I buy equipment with, right? So up here we had depreciation, but depreciation is just an annual portion of the investment that we've put into equipment. When I buy equipment, I spend 100% of the cash on that equipment, but then I'm only able to depreciate it over 5 years, for example. And so let's say that we did buy, just to make this easy, we bought $50,000 worth of equipment this year, and we depreciated over 5 years. I'm using straight line method for this. Just 1/5 of that is our depreciation up there. So $50,000 worth of equipment purchases this year. That is our investing. So that's cash to investing. So we get down here. This was 55 minus 50. So now we're at plus 5. But we need to get to plus 10 because that's the hole that I dug myself into at the beginning of this problem. So this was plus 55. And we're at plus 5 now. The last item that we have is going to be financing, right? All right, so financing. This is loans. This is also owner capital. So financing, we're going to say that out of that $50,000 of equipment that we bought, we financed 40 of it. So this is going to be a plus 40, right? Because increases in payables are a positive cash flow amount. And so if we financed $40,000 of that $50,000 equipment buyout, the actual net cash was only $10,000. But we break this out into operations, investing, and financing so that we can see where did that cash, which department was responsible for generating cash. So we're going to add 40 there. But I also took money out. So just to get us to this $10,000, we're going to do owner distributions. So we're at 45 right now. So I financed that equipment for $40,000, and then I went ahead and paid myself an additional $35,000 in distributions for the year. This is going to get us to that $10,000 increase in cash for the year. Started the year with $20,000 cash, ended the year with $30,000 cash. We made $80,000 net income, but cash only went up $10,000. And so I'm asking my CPA, why did I only make $10,000? My cash only went up $10,000. And I'm going to break this out, and I'm going to say, because you paid yourself an extra $35,000, you bought some equipment, which is good, and you also have all this money sitting in AR. And so you need to get on your customers, and you need to start collecting that AR, because as that AR goes down, then cash will go up. So that's the indirect cash flow method. This is super useful to understand a balance sheet. I'm going to show you one more thing. So I'm going to erase this. So what I will do when I'm cross-checking a cash flow statement and in financial statements is I will put last year's balance sheet. So let's call this 22 alongside 23's balance sheet. And then up here, I'm going to keep it somewhat in the order of a balance sheet with one difference. So I'm going to have my assets up here. I'm going to have my liabilities down here. I'm going to have my equity down here. And that equity is going to include net income down there. And then the last thing that I'm going to have, instead of having cash up here, because cash is where I want to get to in a cash flow statement, I am going to have cash down here. So I'm going to have beginning cash and ending cash down here. And then all I'm going to do is I'm going to plug in my balance sheet into this so that I can see the net change over in this column. And then we're going to break it out between ops, investing, and financing. You can do this for yourself. Just grab an Excel sheet and your balance sheet, and you can figure out a rough number, a rough idea of where your cash went. I've written out my two balance sheets. So I've got 22 and I've got 23. I've got accounts receivable up here, fixed assets and accumulated depreciation. So this is my asset side. And then this section, I've got my liabilities, accounts payable and notes payable. And then down here, I've got my equity. So I've got my retained earnings from all the years combined up to now. And then I've got net income for the current year down here. And then down at the bottom, because this is a cash flow statement and we're trying to get to that change in cash, I've got my beginning and ending cash flow balances down there. All right. So this is the change. Remember, an increase in an asset, as an asset goes up, that means cash actually goes down because my cash is sitting in AR or my cash is sitting in equipment. And so as those numbers in this column go up, the change, the difference is a negative number. Accumulated depreciation is a contra asset account. And so it was negative 30,000 and now it's negative 40,000 because of $10,000 in depreciation. And so that is an increase in cash because it's a non-cash flow item that isn't here in net income that we need to add back in. So don't worry too much about that. That was on the previous screen, but this is how you do your calculations. AP, again, If your ending balance is greater than your beginning balance, that's a positive number because I'm holding on to this cash by not paying those bills. And then same as note payable. So instead of paying $50,000 in cash for the asset up there, I paid $10,000 in cash out of pocket and I financed the rest of it. And so that is a plus to cash flow, $40,000. And then down here in retained earnings, I have my beginning retained earnings, and then I did a $35,000 distribution. So that's that difference there. And then I've got my net income number, $80,000, and I've got my net change in cash, $10,000. If I sum this column up, it's going to give me that $10,000 difference. If I sum up my assets up here and my beginning cash, it should equal the total of liabilities plus equity, right? Assets equals liability plus equity. Or otherwise, assets minus liabilities equals your equity. 23, same thing. So 120 plus 80 minus 40 is 160, plus my cash is 190. And then if I total these up, 80, 135, and 55, 190, right? So my balance sheet is still in balance, even though cash is down here instead of up here. So that's just a way to check your math on this. All right. So I said that this is how you can do it with your own income statements. And now we're going to get into the ops, investing, and financing. So as I look at the growth of my company long term, I want to see that cash from operations is positive, is continuing to go up even, because that means that the company is healthy and is generating its own cash. If all of my cash is coming from the financing category, then we're going to have an issue. Similarly, if all of my cash is going into investing, it just means that we're going to end up asset heavy or we're going to end up investing heavy. So this is why we break down the cash flow statement between operations, investing, and financing, because I want to know when I look at a company, is it generating its own cash or is it having to borrow in order to have that ending cash balance? Are we borrowing money over here because we're not collecting it from customers? If we start collecting money from customers, this would go down. That's going to go down 80. That's going to stay. This is going to be a zero difference. We collected $40,000 extra, and our ending cash is now going to be 70, with $50,000 increased cash for the year. And now my company is generating $95,000 cash from operations. So that is how your balance sheet, that is how your P&L work together. Remember, your P&L always flows into your balance sheet. But if you ever want to break it down and see where does cash fit in, cash is the interplay between your P&L and your balance sheet. We start with beginning cash, we end with ending cash, and we work backwards from our net income. And that is the indirect cash flow method. Anybody can do this, like I said. You build a spreadsheet, you start plugging in your beginning numbers, your ending numbers, and you start working on this, and it's going to give you a lot of insight into the health of your business, into the health of your operating cash flow. Thanks for watching. I appreciate it. Leave a like on this video if it was helpful for you, and we'll see you next time.